Good morning, everyone, or good day from if you're in another part of the world. This is Nick Katko from BMA and Mike DeLuca. Mike, introduce yourself.
Hi, I'm Mike DeLuca.
And we're here today talk about value stream income statements. Let me get our videos off the screen and let me get everything all set up. So the first question I have, just to make sure, can everyone see my screen? Can you hear me? And can you see me? If you just sort of put something in the question pane or chat pane, that would be good. A simple yes. All right. All right. So let us get started. First of all, for those of you who are returning webinar attendees, you're familiar with this. If you're new to our webinars, there's a copy of the presentation in the handout section of your control panel. You can download it. If you are watching this webinar on a recording, then I will be glad to send you a copy of the presentation. Just send me an email. And if you have any questions, please enter them into the question panel, and we'll try to get to questions at the end of the session. If you are a certified public accountant and would like to receive 1 hour of continuing education credit for this course, there are 3 requirements. You have to answer the 3 polling questions, which will pop up. You don't have to answer them correctly, you just have to answer them. You need to stay logged into the event for 50 minutes and attend the live event. And if you want the CPE credit, please send me an email and we will send you a certificate. So just a quick word about this webinar. Mike and I are in the process of writing a new lean accounting book called Practicing Lean Accounting. And we will have this book out in early 2021. And so some of what we're talking about are excerpts from the book. So today's webinar agenda is pretty simple. We're going to talk about the principles of a value stream income statement. We're going to look into more detail about how the costs are categorized and appear on value stream income statements. That's value stream costing. Then we're going to sort of just explain some simple uses of value stream income statement. We'll wrap up and we'll take some questions. As a participant in this webinar, there are 4 learning objectives. At the end of this webinar, one thing we'd like you to get out of this webinar is the ability to explain what the purpose of a value stream income statement is in a lean organization. Secondly, it really relates, second, third, and fourth, it really relates to understanding costs and how costs are categorized on a value stream income statement and what are the benefits, more than just how we categorize them, what are the benefits of showing costs between fixed and variable, direct and shared, and then what are the primary direct costs of any value stream and how they're calculated. The reason being is that cost analysis is it's a very important part of the work of accounting. A lot, leaders of organizations, they want information about costs and what's driving costs. And so part of the benefit of a value stream income statement is aligning the costs of a value stream and even the organization in a manner that supports the lean practices and the overall lean strategy. A value stream income statement can be part of a lean accounting box score, which also includes the value stream performance measurements, value stream capacity. Value stream income statements can also stand alone on themselves. They don't necessarily have to be part of a box score. You can create a value stream income statement for your company. You could take your company's income statement and reorganize it into a value stream format. So there's lots of different, value stream income statement is very much customized for every company and even different types of industries. What works well for your company in your industry? That's really something that, we can't sit here and say, do this and you'll have it. You really have to think about it for your company. So here's the issue, and it's sort of the problem that value stream income statements are trying to solve, is that they're very confusing, or can be confusing, to non-financial managers. The internal managers in a company. If some people intuitively have some experience in maybe financial statements and understand them, others don't. And there's three specific reasons. Number one is the format. And when we're talking about financial statements, we're talking about the financial statements used for external reporting purposes, the monthly financial statements. Well, first of all, the format of these statements, it's, again, we're making broad assumptions here, but we've seen this over the years, that they're primarily designed for accounting and finance and for external reporting. That's sort of how the format is set up. Secondly, managers inside a company, if they're given an income statement to analyze, or just maybe a expense report for their department, the external reporting requirements, GAAP, IFRS, those requirements can sort of mask true operating performance. Accounting has to do accruals. They have to book reserves. They have to do amortization. They have to do depreciation. You have prepaids. You have cost of goods sold. The list goes on and on about, what are the reporting regulations for financial reporting purposes. And they can mask operations in terms of, how did operations perform? This pretty much makes it difficult for a non-financial manager to explain something they don't understand. Then there's this level of complexity, whether it be company accounting policies, the chart of accounts, the general ledger, the level of detail. This also creates a level of confusion and among non-financial readers. So what we're trying to do here is we're trying to create an income statement that is usable for internal managers to understand the business better. Also for accounting, for leaders. It's for everybody inside the business. So how do you get started with a value stream income statement? It's sort of like, how do you get started with lean? Understand the principles. Like I said a few minutes ago, Mike and I, over the course of our work with other companies, we've seen lots of different versions of value stream income statements. And the ones that work are based on these principles. And that's really what's important. If you understand the principles and you follow the principles in building your value stream income statement, it's going to turn out well. So first of all, I think it's important to define exactly what a value stream income statement is, because admittedly, there's still some confusion, because when the phrase income statement is used, especially accounting and finance, their mind goes to the external financial statement for financial reporting purposes. The purpose of a value stream income statement is it's used by management as an analytical tool and to help improve decision making. That is the purpose. And so the idea is to create a simpler, more usable format in terms of how we present the numbers. All the numbers for a value stream income statement come out of the accounting system. And you see in red there, not a second set of books. And that's been said to me many times over the years. You're telling us to do another system of accounting, and it's not a new system of accounting. It is just a format. Does a value stream income statement reconcile to an external financial statement? The answer is yes. And in fact, that's one of the jobs of accounting and finance, is to make sure this all reconciles. So what are the principles we need to focus on? And there are 4. You see them here, excuse me. And so let's look at these principles in a little more detail. Usability. All right. And one thing about value stream income statements and usability is we want to define this from the user's point of view. Lean principle number 1 is value, customer value. So we want to create a format that internal managers can use. They understand it. The format is logical. We're using sort of more everyday language rather than complex financial accounting terms. Maybe less detail. What do these users need? This is the idea of a plain English income statement. And of course, if you're not in the United States or in English speaking language, whatever it is, plain Italian financial statement. It's making it simple and easy for non-financial people to look at and understand. That's principle number 1. The second principle relates to how we look at our costs and how we categorize our costs. We're going to go into more detail about this in a few minutes. Just wanted to sort of summarize it, but there's 4 practices. First of all, we want to show actual costs for the whatever period to understand operating profit. We want to separate variable and fixed costs based on the true drivers of what is variable and what is fixed. We want to show more direct costs than shared costs. As much as possible, we want to really study our general ledger and look at each line item in the general ledger and understand, which of these costs really can, is applied to one value stream, which ones are shared. In some cases, companies may require cost allocation methodologies. If these are required for whatever reason, segregate them, don't include them in the above the operating profit line. One thing we want to do, the third the third principle is visibility, because we want to understand the true drivers of costs. This is the idea of looking at actual direct costs. And this is not just for operations. This is also for accounting and finance and for senior leaders. Think of this as a method to learn. We want to learn over time what what factors in operations are actually driving the costs. One phrase I use periodically in training sessions is that if you want to change the financials, if you want to change your costs, if you want to better manage your costs, you have to better manage operations, or you have to change operations. That's really the only thing that's going to drive costs. We can't look at costs from a top-down viewpoint, meaning accounting, finance, and senior leaders sit there and do cost analysis and say costs have to go down 5%, tell managers costs have to go down 5%, and expect it to happen. Long-term cost management in a lean environment is about understanding these relationships between operating performance, capacity usage, and financial performance. These relationships are very dynamic. There's also a lot of dependencies, as I just mentioned. And the more that these relationships are analyzed and understood, the better an organization is going to get at controlling and managing costs. And again, this is something that it's not done on a spreadsheet. It's not done by accounting and finance in isolation. It's very much a collaborative effort between accounting and operations. And part of it is accounting and finance going and seeing what's going on in operations, and how can we learn by actually watching operations. How can we learn some of the drivers that will allow us to better understand why we're getting the costs we're getting. The final principle is value. What we want to do, the overall value for an organization, is improving the decision making by using a value stream income statement. The value stream income statements deliver relevant and reliable financial information, relevant to the decisions that are being made, and realistic. Using actual direct costs, those costs can be verified. Foundationally, as I just mentioned, actual costs are foundational to a value stream income statement, and also the idea that value streams are the profit centers of a lean organization. From a lean viewpoint, value streams are an organizational unit. That's the way we manage. That's the way orders and work flows. And from a financial standpoint, they are the profit centers. And so we want to look at each individual value stream discretely because of different operating characteristics, different problems and issues, different customers, and that all those operational impacts of a value stream can impact financials. So what I'm going to do here is we have our first polling question. So I have to open up the poll, and I'll give you about 30, 45 seconds to answer. So which of the following statements is not true of a value stream income statement? That it completely replaces a company's current income statement, it's designed for internal analysis and decision making, it's a simpler, easier format for internal users, and it reconciles to external reporting financial statements. All right, got a few more seconds left. Try to get your polls in. All righty, I'm going to close the poll. I'll quickly share the results. So the first one that most people got, that it completely replaces a company's current income statement. That is not true. All right, so I'm going to hide the results. I have to do a little bit of maneuvering here. And the next part, we're going to talk about value stream costing practices. And I'm going to turn it over to Mike.
Great, thanks, Nick. So we've started out really by talking about principles of the value stream P&L, the value stream income statement. And we're really focused on how to make our internal financial analysis reports, our reporting of profit and loss, useful, right, for the end user. Is it fit for purpose? And so Nick talked about 4 principles: usability, simplicity, visibility, and value from the end user's perspective. Because like you said, Nick, we want the information to be clear so that the internal users understand it, can make decisions based on it, and take action. So in order to delve into that, we need to think about how we understand the behavior of costs in the organization. And then in order to be able to reflect those in a way that the end user can understand them, make decisions, and take action to improve them. So one of the key things that we need to think about is, how do we understand cost behavior in a way that we can clearly separate it on our income statement? And so we want to talk about how to separate variable and fixed costs. And this really requires that we think from a lean perspective, like I said, about the cost behavior. What is a variable versus a fixed cost? And how does that really show up in the lean organization, in particular, as we do improvements, continuous improvement to our processes? So let's think about these from the lean perspective. A variable cost are really only those costs that change in the short term, specifically with the volume of products or services that we're providing, that the organization is providing to customers. And my background is mostly healthcare finance, and we had a belief that all of our frontline healthcare costs were variable with volume, and that was how we reflected them on our reports, and we used that to make decisions. And that was prior to bringing lean thinking into the organization and to really adapting and adopting that in accounting. And the reality is that many costs that we consider variable are fixed in the near term. So variable costs are truly only the ones that vary with short-term volume changes. So we can think about the actual consumables that are used in either producing a product or delivering a service, as opposed to fixed costs, which don't vary with short-term volume changes, but are influenced by management decisions. And so I think the important shift here is that unless you're in an organization where the people who are producing the product or service are truly paid on a piece-by-piece basis, which is not as common, then most of our labor costs are fixed in the near term and influenced by management decisions. And so an example is, my dad was a quality engineer for General Motors, worked in an assembly plant, and the labor cost for a shift in the assembly plant was relatively fixed. The line could move faster or slower based on the customer demand within certain parameters before they would have to add a second shift. So that's influenced by a management decision. But other than that, that labor cost is fixed in the near term. So that's really the important lean conclusion, is that most costs are more fixed in the near term. We also really want to place more focus on understanding direct costs than shared costs. And this requires that we, and one of the things that is really important to do when you're thinking about the value stream income statement is actually how can you get firsthand information about what's actually happening in the value stream? Is there a way to go and observe what the work that's taking place, either to produce the product or to deliver the service, so you can understand firsthand what those direct costs are? What is it that the managers are controlling? And you know, I heard frequently from managers, you know, Mike, there's all this information on my P&L that I'm not controlling, and it's clouding my ability to say, what do I actually have influence over? So I think that's a really important insight, is to understand the direct costs, the ones that are truly controlled by the value stream. And that's, again, in manufacturing, it's the direct costs that we see happening on the shop floor, in a service organization, the direct costs in delivering a particular service to a customer. And these can easily be charged to one value stream. So you might have multiple value streams, and if one value stream truly owns or is responsible or controls that cost, then we want to have it with the direct costs for that particular value stream. As opposed to shared costs, this could be any kind of a maintenance, it could be in healthcare, it's your sterilization services that support multiple value streams. But we do have costs that directly support the value stream but are shared by more than one. And so the value streams may influence those. Certainly the demand in that value stream influences the actual workload placed on that shared service. And there's some influence around the processes because they interact, but those are shared costs, and we want to keep those separate from the direct costs. And then business support, like those of us in accounting, human resources, other corporate functions, planning functions are costs that we do want to keep separate and really avoid assigning and allocating. So we're going to talk about 4 specific examples or types of costs: labor, materials, machine or equipment, and other direct costs as we get into direct costs. So we'll start with labor. And I went into some details on this already, but again, the cost basis, we really want to think about which employees are actually assigned to work in this value stream. Can we be really discrete or clear in our assignment, in the way that we structure the general ledger, in a way that employees report time? Is that time reported specifically to this value stream? I was working with one organization, one manufacturing organization that was trying to really clean up its value stream P&Ls, and they had parts of the value stream that were discrete and parts that were shared. And so they had simple ways for employees to assign their labor time without being overly cumbersome, so that they could be clear on which time or labor cost was associated with which value stream. So Nick, if you want to jump in and take us through material.
Yeah. Okay, so material. You know, the basis for the actual cost is how much material comes into the value stream. You know, this could be what's purchased or what is issued in the value stream. Now, you know, this, I'll be very honest and frank here. This sometimes causes a bit of confusion in accounting and finance, because accounting and finance, especially like from a manufacturing viewpoint, we are trained on cost of goods sold and the material content of what is sold based on the revenue. And this is one of the primary differences between external reporting and a value stream income statement. Think of this. You know, a value stream income statement is an analytical tool, okay? And we want to establish these relationships between operating practices and financial performance. And so you bring material is issued into a value stream. And I call it 3 outcomes. When material comes in, there are 3 things that can happen to the material. It can be produced and shipped, which is good. It can also be scrapped, or it can be stocked. Now, we want to minimize, from a lean viewpoint, we want to minimize scrap, we want to minimize stocking. So if we are looking at the input on a value stream income statement, now there can be relationships developed between defect rates or scrap rates or rework rates, and also, for example, days of inventory. And so it allows the organization to start making these connections. And if you reduce material input, if you reduce the scrap, you reduce the stock, you're going to reduce material purchases. That will show up on the value stream income statement. How does that show up externally? It's cash flow because of inventory issues. So, just keep this in mind as you're developing a value stream income statement, because people need to understand the concept in order to understand why we're looking at issuance.
Nick, you talked about one principle was visibility. And as we're talking about all of these costs, I think for me as an accounting professional, it was important to really shift my thinking from what's the best analytical approach to what best informs the improvement approach. And so it's just a different, it's a slightly different frame, but to think about, and even as we think about materials, whether it's service or manufacturing, this idea that I tended to focus first on what's the best analytical approach for reflecting the materials. Are they reflected at the point of use? Are they reflected at the point of purchase? All of these different questions. And what Nick, you talked about earlier was one of the 4 principles is visibility. It's important to really think about how is our reporting informing improvement. So what we're trying to do is make opportunities for improvement visible, and that should really inform the approach for understanding and making the costs visible on the statements.
Machine costs are pretty basic, and because machines and equipment can be easily assigned to a value stream, because most of them are in a fixed position. What's the depreciation? What's the repairs and maintenance? Do you have tooling? Do you have utilities? Pretty basic stuff. Once you understand where they are, it's pretty much easy to assign the costs. And then there is always the other category. And this is really about studying your general ledger and looking at the different line items of expenses, and maybe getting into a little bit of detail about what's in these expenses, what's being charged there, and really, taking it apart and trying to easily and logically, as much as possible, assign as many direct costs as possible. When I've worked with companies on this, it's usually a collaborative approach, meaning it's both finance and operations looking at these numbers and really getting a better understanding. Can this be done? Sure. It's maybe you have unique supplies. We've seen sales commissions being charged directly to a value stream. Do you have any other examples, Mike?
No, not
at
the moment.
Okay. So let's move on to the shared costs.
Yeah.
So you're going to encounter shared costs. It's just a natural part of businesses, and that certain expenses, certain spending benefits more than one value stream. So, we explain these characteristics of shared costs, and it's important to identify these and then develop what we call a method to assign, okay? Why do we want to assign costs, these shared costs? Well, we want to get a good picture of value stream profitability. We want to keep assignment methods simple and easy, and really match the assignment method with the purpose. And the real purpose of assigning value stream costs or shared costs to value streams is, okay, we just want to get a good understanding of actual value stream operating profit. So,
And as you said
here,
earlier, Nick, the shared costs can be influenced by the value stream. So making these visible is important in helping the value stream leaders and the value stream team understand how is it that we're drawing on or impacting or driving shared costs.
yeah, yeah. For example, these are, facilities can apply to both manufacturing, service, healthcare, production monuments can be, in manufacturing, it could be a paint booth or an upstream operation that's preparing a lot of parts that are used in multiple value streams. In healthcare, an example of a production monument, could be the imaging department that, all the different value streams use the services of the imaging department in
Mm-hmm.
their treatment of patients. So, there's
Right.
lots of different examples of this, and um, it's really important just to understand this and keep it simple. Okay, that's really the point here, is not to create complex methods, because we want to, a value stream manager, we just want them to understand how they can possibly influence the cost.
Mm-hmm.
Now, for example, like imaging, we don't want a healthcare value stream to say we want to do less imaging, because it might be a necessary um, activity to diagnose a patient. So, we don't want to drive the wrong behavior. We want to drive the right behavior in this. And that's really the whole point.
Right, so we want to make the best use of that imaging equipment for all of the value streams that are sharing it. And that's what we can learn through this
Yeah.
in that particular example.
Yeah. Okay. And final thing is cost allocations. Cost allocations exist in organizations uh, for various reasons. And the best approach here is to segregate and separate these allocations from the value stream operating profit. Now, this example here, it was a manufacturing company that BMA worked on many, many years ago. So, the valuation of inventory is really a cost allocation methodology. So we separated that. They separated that. They also had a corporate overhead policy where each unit or each factory was assigned so much corporate overhead. So this was segregated. The whole point there is, operating profit of about 210,000 is then reconciled to the reported profit of 152,000 by making the segregations visible on a value stream income statement. Anything you wanted to add, Mike, in terms of cost allocations in other companies you've worked with?
Well, I mean, I think just a couple of things, and this is a little bit about allocations and also a little bit about shared costs. This idea that both in manufacturing and in service industries, it's really helpful for decision making and improvement purposes to make visible and understand things like the use of square footage. And so one of the organizations I worked with, a healthcare organization, we walked the value stream and realized, and this was for a particular medical procedure, a high cost medical procedure done in the heart or the cath lab. And what we learned was that supplies, when they came into the loading dock, and these are things that are extremely expensive in these cases. So you could have something used in a heart procedure that's where that individual supplier implant is $30,000 for one thing in terms of its cost. And what we learned was that there were 16 possible places in this hospital that those could be stored and from which they needed to be retrieved in order to provide services. And I'm sure you have stories like that whether it's service or manufacturing industries, it was important to think about how to, without overdoing it, without complicating the financial statements, how do we make that visible? And it was beneficial for a couple of reasons. One, because it helped them realize that they had more supplies on hand that they needed, but still wasted a lot of time trying to find them. So it added time. It took away from the capacity of the people doing the work, right? And it took away from the better usage of the square footage. And the punchline to this particular story is this company was designing a new hospital and needed to figure out how much storage space it needed for its services. And as we walked all of the existing space, we realized they needed less than half of the storage space in the new hospital than they had in the existing one. So I just want to tie our analytical approaches back to what are we making visible and how is that improving the understanding of performance, whether it's the use of the storage space or the unused supplies that are being held in inventory that we're finding some way to allocate. It's not because we're after the perfect analytic approach, but because we want to bring visibility into what the organization can do to improve performance. And it's a perfect analytical approach, but that's secondary.
All right, polling question number 2. So which of the following are cost categories on a value stream income statement? Variable and fixed, direct and shared, allocated, or all of the above? All right, we got about 10 more seconds. A few more people need to vote. Looks like we have everybody share the results. So yes, all of the above. So there's really no wrong answer, but it was all of the above. All righty, so that's polling question number 2. And so let's move on. We'll talk a little bit about using the value stream income statement. Now, we've covered this sort of a few times. There's this idea in lean accounting of looking at weekly reporting. Okay, what can we report on a weekly basis to begin to understand the relationships between financial performance, operating performance, capacity performance? Now, here's the idea. The more frequently that reporting occurs, the more frequently there's going to be visibility, insight, studying, and learning. Okay, the traditional accounting cycle is the monthly cycle. And the more that you look at things on a weekly basis, you just develop a better understanding. For example, a weekly box score. Now, there's a lot of information on here, but it's something to consider. Now, when I was a CFO at Bullard in the 1990s, we went to something similar to weekly reporting. It wasn't a complete income statement. What we did is we looked at how much did each value stream spend each week. And it was pretty much just running some reports from the general ledger and giving them to the operational value streams. And they actually liked it because it gave them an idea of what they were spending. And if you understand what you're spending as you're spending it, it's sort of like looking at your bank balance or looking at your checkbook or how much money do you have in your wallet. You have still the opportunity during the month to possibly make adjustments. If you're over in one area, maybe you can come in another area. So this is something to strive for. Okay, it's not necessarily a complete income statement, but it is, what can we provide on a weekly basis? So in terms of the decision making, the general approach is to, whenever you're looking at a potential financial decision, calculate the incremental financial impact of the decision. So what are the relevant costs and revenue for this decision? You know, how do these costs change, and maybe the revenue also, based on the time frame of the decision? If there's understanding of the relationships, this is not that difficult, okay? Especially when you're using actual costs. And so the easiest way to show you this is with two very simple everyday examples. I'm not too worried, and we're not going to talk too much about the performance measurements, but here we have a current state box score with a value stream income statement. So here's an opportunity, and that's in yellow. So the opportunity is a one-time order from a customer for 1,250 units. You can see the customer's going to pay $26.25. We got, what cost do we know? We know the material cost, it's $16.40. So what else do we need to understand about this one-time order? Well, what is the impact on capacity? And we see that we need about 10% productive capacity to meet this one-time order. Our available capacity in the current state is 18.79%. So we have plenty of capacity, and this is a one-time order, to meet it. So you can now calculate, what is the true financial impact? We increased the contribution margin and value stream profitability by $12,313 by accepting this one-time order because we have the available capacity. Our labor costs, our machine costs are not changing. So let's just use the same value stream, but let's look at an example of an increase in demand, 1,500 units a month at $38, but it's monthly. So, we're dealing with a longer time frame here. So we can see that we need about 12% capacity to meet this monthly demand. Now we have 18.79%, so theoretically, we have enough capacity. However, if this is a collaborative decision, operations, they don't want to reduce available capacity below 10%. And if we didn't do anything, we would. So the idea is, well, in order to meet this monthly demand and maintain about 10% available capacity, we have to hire 2 people. So that's going to change our labor cost. But you can see on the value stream income statement that this is still a very profitable decision. So, in this example, the time frame is longer, it's sort of permanent. And so we have to look at this idea of not sacrificing long-term available capacity, just to quote unquote save some money. So let's do polling question number 3. And then we will wrap things up. So value stream income statements can be used for weekly box score reporting, to make decisions, to get a better understanding of company profitability, or all of the above. All right, I'm going to close the poll because we pretty much all voted. And I had to share the results. Sorry about that. So everybody did a good job there. All right. So let's go into the wrap up. There are basically 5 steps to creating a value stream income statement. Identify the value streams in the organization. That's more of a lean exercise than a lean accounting exercise. Once you've identified the value streams, then focus on what revenue does each value stream generate. Second step, look at your costs. What are the actual direct costs? What are the shared costs? Third step, and this really, gets into looking at costs a little more, separate out all of these functional costs. In this case, it was new product design and the support. That's all the selling, general, and administrative costs. So again, there's a lot of time spent looking in the general ledger and looking at the expense line items. And it's really about taking the time in sort of an objective way to determine where should we categorize these in terms of a value stream income statement format. We want to get to a value stream operating profit. Now, here's sort of a bit of advice based on the companies I've worked with. You probably will notice that the operating profit using actual costs is much different between value streams, and also much different than what you may have looked at in the past because of the way you're assigning these costs. And then finally, segregate the cost allocations. Those are pretty much the 5 steps to follow. If you follow the principles, you will be able to create a value stream income statement for your company.
And I would just add one quick thing. It's possible that your company is early in its lean journey, at least this was our experience, and you don't have identified value streams yet. And we were impatient with our existing profit center P&Ls, and rather than waiting for value streams to be firmly identified, we went through the same process just with the existing profit center P&Ls to clean them up, to use the same principles and create a much better interim management tool. So you can use this same approach to existing profit centers if your company hasn't yet clearly identified its value streams.
All right, and value stream income statements create value for internal customers, internal users. We create reliable cause and effect relationships between financial outcomes and operating performance. And finally, value stream income statements, this is sort of what I consider more of a hidden benefit. It creates a lot of collaboration and cooperation between finance and operations. Operations naturally has a better understanding, and this whole idea of finance and operations working together to gain better knowledge and insight into the drivers of financial performance is beneficial to an organization. All right, so final reminders, then we'll take a look at some questions. You'll get a survey at the end of the webinar. Please complete it. It helps us make our webinars better. And learning opportunities in terms of going to the BMA website to join our mailing list. There's blogs, videos, recorded webinars. If you want to contact myself or Mike, here's our information. We have the Lean Accounting Community Chat Wednesdays at 11 o'clock, and there is the link to join that. We have one coming up next week, and then one in December. Then we'll start it back in January. And if you'd like to become part of the Lean Accounting community on Slack, contact either Mike or myself, and we will send you an invitation. So let me see if I can get my mouse working. All right, I'm looking at some questions. We have about 5 minutes. One question from Marat is sales commissions depends on cost of goods sold. Should we categorize them as variable costs? The short answer is yes. Sales commissions could be considered a variable cost. Margie had a question. What software systems are corporations using to track and report their financial numbers? How hard or easy is it to make these changes to create these reports? That's a very good question. Mike, do you have any answers for that?
There are, not a great one. There are a lot of systems out there. Most of the ones that I've seen organizations use have a good bit of flexibility. We had a reasonably old system and it still had enough flexibility for us to completely change the way that we were allocating and showing costs. So
Yeah, one thing about sort of general ledger systems, you have an account number, and usually, but not always, there's a number for an expense account, and then you have the ability to create departments or cost centers, things like that, which you can take your labor expense and show labor expense for department A, B, and C. And so what I've done with some companies is say, use that cost center field or that department number and just make it your value streams. And then naturally, you're going to be getting a pretty good value stream income statement out of your system. A final question from Dan. And this is a good one. How low in an organization do you share financial data? And how receptive have companies been with sharing data with mid-level managers? Well, I think, my answer is that I've seen a spectrum. I've seen companies that are very open with financial information. When I worked at Bullard, we had a monthly company meeting where the entire company, all the employees attended, and we shared at a high level, how did we do last month? I've seen companies take it to the managerial level. I've also seen companies that are, for one reason or another, very protective of some financial information and they don't want to share it. How about you, Mike?
Transparency is really one of the principles that we're talking about. We want to make information visible, but I think in terms of the spectrum of transparency, what's important is that the level of management that you're at has the visibility into the information you need to understand and make better decisions. And so that may mean what I've seen at the team level in really evolved lean organizations is actually there's very little financial information at the team level. What the team is focusing on are the process measures that they're responsible for that actually influence the financial outcomes. And then the company, to Nick's point, they make their decisions around how transparent are they with the financial results on a weekly, monthly, or quarterly basis. But what teams need to have visibility into is what are they in control of that drives or influences those cost or financial outcomes.
Yeah, I think one of the drawbacks of not sharing financial information, even just down to the sort of like the operational management level, you don't have to maybe share the complete company financial information, but what do I have influence over? I think the drawback of not doing that is operational managers getting surprised when they get asked questions that are based on somebody else sort of doing the analysis and saying, well, why did this happen? Why did that happen? I guess it at one level can put operational managers on the defensive. Why am I being asked this? I thought we were doing well. And so, it's about learning and visibility and teamwork. I also think that, everybody who works in an organization, they want to see the organization do well financially and be successful. And the more that they understand how they can influence that, the more collaboration you get. Okay, those were the questions. I'm glad we got to answer them. Thanks for asking them. Thanks for attending the webinar. Tomorrow, you will get a link to the recording. And if you have any questions, please contact us at any time. Mike, any closing words?
Nope, I appreciate everybody's attendance.
Okay, so everyone have a good day. And for those of you who are in the United States, have a good Thanksgiving. And everyone, please stay safe and take care of yourselves. Bye-bye.
Thanks.